Are you retired? Are you proud that you didn't pay any taxes last year? You might actually be failing your tax retirement planning. Stay tuned to learn more as we cover 4 tax planning principles for retirement. Many folks are focused on market risk in their portfolio. As they near retirement, the traditional wisdom is to dial back that portfolio risk since you'll be using that money soon. For many retirees, they have painful memories of times like 2008 when the market descended over 40% and took a few years to recover. So with that, they want to make sure that they're prepared and they're concerned about that risk in their portfolio. We see folks often overlook tax risk in their retirement plan and fail to do proper tax retirement planning. Throughout this video, we're going to cover 4 tax planning principles to help you stay on the right track with your tax planning for retirement. I believe proper tax planning allows you to take less risk in your portfolio in retirement and thus is a critical part of your retirement plan. If we haven't met yet, I'm Josh Leonard, President and Financial Advisor at the Leonard Advisory Group, where we help those nearing and in retirement to retire with intent. I am the host of the Relax It's Retirement podcast. I do monthly webinars and short educational videos like this one. If you haven't already, make sure to like and subscribe this video to make sure that you get future postings that we have relating to your retirement success. Let's jump right in to 4 principles for your retirement planning. Number 1, tax rate is more important than tax bracket. A tax bracket is an income range in which you'd be taxed at a specific percent. Your tax rate will bring other things into play. How much of your Social Security is being brought in to be taxed? Any credit phase outs? Indirect impact to things like Obamacare subsidies or your cost of Medicare. When we're setting up a retirement plan, or if we're looking at a year where our income might be higher than normal, we want to make sure that we don't run into any tax pitfalls causing us to jump up into a higher tax rate, even if we're staying in a lower tax bracket. One of the common ones overlooked is Social Security, as I mentioned before. As your income goes up, more of your Social Security gets brought in to your retirement plan. At the peak of this, at the tax torpedo of this tax situation, you would have dollars in income actually being taxed at almost 50%. We want to avoid that. Other times we might see folks try to do large Roth conversions to stay within an individual tax bracket, but that might push up the cost of their Medicare. So we want to look at that total tax rate rather than just the tax bracket. This is often overlooked and can cause you to pay, whether directly or indirectly, a lot more in taxes. Number 2, permanent is not a proper tax term. Things like the Tax Cuts and Jobs Act, also known as the Trump tax cuts, have provisions that will sunset. A lot of the individual tax cuts that we've all been enjoying, like lower tax brackets, higher standard deductions, those will sunset at the end of 2025, reverting back, unless another law is passed, to our previous tax brackets in 2026. As part of that same bill, we had permanent tax cuts for corporations. This might not actually be as permanent as it states in the bill. Changes to taxation can be done through reconciliation rather than a traditional bill. Reconciliation only takes a simple majority rather than a 2/3 majority as we have for traditional bills. This allows one party to push through legislation a little bit easier as long as they have that simple majority. We have seen things like RMDs change, the year in which you need to start taking forced withdrawals from your qualified retirement accounts. We've also seen the tax brackets change. The way we deduct some things is capped at different rates, like our state and local income tax. All of these tax things, while they might be permanent now, can be shifted in the future. So we want to plan prudently with our tax plan, but know that some things might change in the future. A QCD, or a qualified charitable distribution, is a distribution after age 70 and a half from your IRA to a qualified charity. As long as this is done after age 70 and a half and doesn't pass through you or your bank account, it goes direct from the IRA to the charity, it is a non-taxable event. Now, once you reach the age in which you need to take required minimum distributions, these QCDs can work towards that RMD. However, you are responsible for reporting these on your tax forms. If you're not reporting that that money was not sent to you, but rather to that qualified charity, you'll still be taxed on that money. We've ran into a few scenarios where individuals that were doing their own retirement planning and preparing their tax returns knew enough to do the QCD, but did not report it correctly when doing their taxes. This negates the whole tax advantage of doing a qualified charitable distribution. Other tax planning strategies like NUA, which is company stock that was purchased within a qualified retirement plan, we can treat this in a specific way to help get a tax advantage and ideally, in most situations, pay lower tax on that portion of your qualified retirement funds. If these are not reported correctly, again, we're negating that whole tax bill. So number 3, if it's not reported correctly, it didn't happen. This is often the value of working with financial professionals like a financial advisor or a CPA when you're trying to take advantage of some tax planning strategies. By reporting them correctly, you get credit for the homework. You didn't just do the homework. Number 4 tax principle, the lowest lifetime tax bill wins. As I mentioned at the beginning of the video, by looking over our lifespan, we want to have the lowest possible tax bill on average throughout that whole time, not just in 1 year. If you don't think you're going to use all of your retirement funds through your lifetime, and the intent is to pass a big chunk of your wealth on to the next generation, we want to factor them into play too. Many times, kids inherit funds, like an IRA from their parents, in which they're forced to distribute over a 10-year time period. If they're in their highest income earning years, they might be in a way higher tax bracket than you are. Thus, let's plan for that and try to make the lowest lifetime tax bill on these funds. We can take advantage of tax strategies like tax gain harvesting. Many folks might have heard of tax loss harvesting, where you try to sell off some stocks or investments that have underappreciated to help offset the gains in your portfolio. Sometimes in a lower tax year, it makes sense to actually sell a stock that's done really well, realize the gain, and then buy it again. This steps up the cost basis in those shares. If you need to liquidate those shares in the future, you'll have a higher cost basis, thus resulting in lower taxation for you. Sometimes we'll hear folks say, well, shouldn't I have a Roth IRA? And while I love Roth IRAs, typically having a Roth IRA is not the goal. The goal is to pay the least amount of taxes. So tax diversification, or having different taxable types of accounts, is often a byproduct of tax planning rather than the goal. The goal should be having the lowest lifetime tax bill, not the most diversified tax picture or the lowest individual year of taxation. I hope you learned something from these 4 tax planning principles for retirement. Are you interested in digging deeper? Do you want to optimize your retirement plan to have the lowest lifetime tax bill? Schedule a 15-minute call with myself or one of our team members to discuss how we might be able to help you lower your tax bill in retirement. If you haven't already, make sure to like, subscribe, and click the bell to be notified when we upload a new video. Thanks for joining, and look forward to seeing you again soon.